Managing finances well is important for everyone, whether you're an individual or running a business of any size. A key part of handling finances is understanding two main concepts: assets and liabilities. These are the two main parts of a financial statement called a balance sheet. Assets are things you own that have value and can help you in the future. Examples include cash, property, and investments. Assets are valuable because they can help you earn money or save on expenses. Liabilities are debts or obligations that you owe. They represent money you need to pay back in the future, such as loans or credit card balances. Managing liabilities well is important to avoid financial problems and ensure you can meet your future obligations. In this video, I'll explain the difference between assets and liabilities in detail. Then, I'll show you how to get more assets and reduce your liabilities. Don't forget to comment, "I'm ready to change my life," if you're committed to your financial journey. Your path to wealth begins now, and I'm here to support you every step of the way. Let's get started. Understanding the difference between assets and liabilities is crucial. An asset is anything that has value and can potentially generate money or benefits in the future. This means it can help you make or save money. Let's use a common example: a car. When you buy a car, its value decreases significantly the moment you drive it off the lot. New cars lose value quickly, and used cars are worth much less. So many people argue that a car shouldn't be considered an asset because it doesn't increase in value over time. Here's the key point. For something to be a true asset, it should generate profit or add value. A regular car, which depreciates quickly and doesn't make you money, is not a good example of an asset. Whether you sell it soon after buying it or keep it for years, you're unlikely to make a profit because it's not worth more when you sell it than when you bought it. However, there are exceptions. For instance, historic or collectible cars can increase in value and can be considered assets because they can potentially generate profit. But in most cases, when people buy a car for personal use, it's not an asset in the financial sense because it doesn't help you make money or appreciate in value. Is a house an asset? The question of whether a house is an asset can be nuanced. For many, buying a home is seen as an asset, but this isn't always straightforward. If you purchase a house to live in, it often represents a significant financial commitment rather than an immediate asset. Owning a home involves regular expenses such as mortgage payments, property taxes, and maintenance costs. These ongoing payments can drain your finances over time and do not directly generate income. In this sense, a home can be considered more of a liability because it requires consistent spending and doesn't provide immediate financial returns. However, the situation changes if you buy a property with the intention of selling it for a profit. If you invest in real estate with the goal of reselling the property at a higher price, then the house can indeed be classified as an asset. This potential for profit aligns with the definition of an asset as something that can generate financial benefits. Investments as assets. In addition to real estate, investments like stocks, shares, or bonds are also considered assets. These investments are purchased with the expectation of earning a return. Investments are valuable because they can provide measurable financial benefits. For instance, owning stocks or shares in a company may result in dividend payments, which are regular distributions of the company's earnings to shareholders. Alternatively, investments can generate profits through capital gains, which occur when you sell the investment for more than its purchase price. Thus, investments in financial assets are considered assets because they have the potential to produce returns on your initial expenditure. The distinction between tangible and intangible assets is quite straightforward. Tangible assets are physical items that you can touch and interact with, such as land, buildings, equipment, cash, and inventory. These assets are concrete and measurable, making them easy to value and manage. On the other hand, intangible assets lack a physical presence. They cannot be touched or directly interacted with. Examples of intangible assets include brands, patents, and copyrights. Although these assets are not physical, they still hold significant value, often contributing to a company's overall worth. The concepts of real versus financial assets are often confused and lumped together with tangible assets. However, they are distinct categories. Real assets possess intrinsic value, meaning their worth is based on their inherent qualities and usefulness rather than their market price. This intrinsic value reflects the true value of the asset in practical terms. Examples of real assets include real estate and commodities like gold. In contrast, financial assets derive their value from market prices and contractual agreements. These include stocks and bonds. The value of financial assets can fluctuate based on market conditions, which means you might end up paying more than their actual worth. This is why investors like Warren Buffett emphasize understanding a company's intrinsic value before buying its stock. If the market price is lower than this intrinsic value, it suggests potential for future profit when the market price rises closer to or above the intrinsic value. Financial assets, unlike real assets, are typically easier to convert into cash. This is because they are more liquid and can be traded on financial markets, whereas real assets such as real estate or commodities are harder to sell quickly. By the way, if you're finding this video helpful and want more content like this, comment more below. Let's keep going. Stocks are often considered the most important type of asset, and understanding them is key to investing wisely. What are stocks? Stocks, also known as shares, represent ownership in a company. When you buy a stock, you're purchasing a small piece of that company. Think of it like owning a tiny part of a house. If you own one brick from that house, you're part of that household because you own a piece of it. Similarly, owning a stock means you own a small portion of the company. Why buy stocks? The main reason people invest in stocks is for their potential to grow in value over time. If the company performs well, the value of its stocks can increase, potentially leading to a profit when you sell them. Additionally, if you own a significant number of shares, you might gain voting rights, allowing you to have a say in major company decisions. In short, buying stocks means you're becoming a part owner of a company. If you own a lot of shares, you have more influence and a greater potential for financial rewards as the company succeeds. Making money with stocks generally involves two main strategies: capital gains and dividends. But here we'll focus on capital gains. Capital gains. This is the most common way to profit from stocks. Here's how it works. 1. Buying low and selling high. You purchase shares of a stock at a low price with the expectation that its price will increase over time. For instance, if you buy a stock for $5 per share and its price rises to $7 per share, you can sell it for a profit. In this case, you'd make a $2 profit per share. 2. Price fluctuations. Stock prices don't just move in one direction. They fluctuate due to various factors like market demand, company performance, and economic conditions. Stock charts track these price movements over time. They show how the stock's price has changed and can help predict future trends. 3. Market demand and supply. The price of a stock is influenced by how many people want to buy or sell it. When more investors want to buy a stock, high demand, the price tends to go up. Conversely, if more investors want to sell it, high supply, the price might go down. 4. Predicting future value. Investors often buy stocks they believe will increase in value. They use various methods like analyzing company performance, industry trends, and market conditions to predict which stocks will rise. If they're correct, they can sell the stock at a higher price than they bought it for, making a profit. 5. Risk involved. Investing in stocks carries risk. Prices can go down as well as up. If you buy a stock hoping its price will rise, but it falls instead, you might lose money when you sell. This is why stock investing is sometimes seen as a gamble. However, careful research and analysis can improve your chances of success. 6. Research and analysis. To minimize risk and increase the chances of making a profit, many investors analyze companies before buying their stocks. This involves looking at financial reports, industry conditions, and market trends to make informed decisions. Good research can help you choose stocks that are more likely to increase in value. In summary, capital gains involve buying stocks at a lower price and selling them at a higher price. Dividends provide a second way to make money from stocks. They are payments made by a company to its shareholders, sharing a portion of the company's profits. These payments are typically issued on a regular schedule. Yearly, quarterly means every 3 months, or semi-annually means twice a year. Essentially, dividends represent a reward for owning a piece of the company. For example, if you own 1% of a company's shares, you receive 1% of the total dividend payout. This provides a steady income stream in addition to potential gains from selling the stock at a higher price. Acquiring stocks can be done in a few ways. The most common method is through online stockbrokers, which are digital platforms allowing you to buy and sell stocks via the internet. You create an account, deposit funds, and use the platform to place trades. These brokers charge fees for transactions, and it's wise to compare different brokers to find the most cost-effective option. Another method is to use bank investment services. Many banks offer investment accounts where you can purchase stocks and other financial products. Similar to online brokers, banks charge fees or commissions for their services, which can be higher compared to online options. So reviewing these fees is important before deciding. Alternatively, you can buy stocks directly from companies through direct stock purchase plans. This method allows you to purchase shares directly from the company, potentially avoiding some fees associated with brokers. However, it often requires more capital and involves more paperwork, making it more complex and less flexible than other methods. Regardless of how you acquire stocks, it's important to be aware of transaction fees and taxes. Each purchase or sale usually incurs fees, and profits from selling stocks and dividend income are subject to taxes. Understanding these costs can help you manage your investments more effectively. Real estate can be a valuable asset, but its role varies depending on how it's used. If you own a home simply for living in it, without intending to sell, it's considered more of a personal expense rather than an investment asset. However, for those involved in real estate investing, properties are viewed as assets. In real estate investing, you start by searching for underpriced properties, which are typically properties that have been poorly managed or need significant repairs, thus being priced lower than their potential value. After purchasing such properties, the goal is to enhance their value through improvements. This can include fixing structural issues, modernizing the property with updated fixtures or appliances, repainting, or even staging it with furniture to make it more attractive. These upgrades aim to increase the property's market value, making it possible to either sell it at a higher price or rent it out for a steady income stream. Several factors influence property prices, including market timing, location, neighborhood quality, economic indicators, and interest rates. Properties in prime or developing areas, for instance, tend to appreciate more. Broader economic conditions, such as employment rates and inflation, also play a role in determining property values. Real estate comes in various types, including residential, homes, apartments, commercial, office buildings, retail spaces, industrial, factories, warehouses, raw land, undeveloped land, and special use, schools, hospitals. If buying, renting, or selling property directly is not feasible due to lack of funds or expertise, there are alternatives. One such option is investing in real estate investment trusts. Real estate investment trusts are companies that manage or finance real estate and allow you to invest in real estate through shares in the company. This method provides access to real estate investments without the need to handle properties yourself and often offers high dividend yields and potential for long-term appreciation. Knowledge is considered an intangible asset because it holds significant value even though it isn't a physical item. To illustrate this, imagine you own a marketing company that specializes in helping businesses attract more clients through online strategies. As the business owner, you handle the core aspects of marketing, such as developing strategies and creating content. However, managing everything on your own isn't feasible. Therefore, you delegate tasks to various specialists. You start by hiring an accountant and a financial advisor to manage your company's finances, ensuring that the financial aspects are in order so you can concentrate on other areas. Next, you employ content creators who produce the marketing materials necessary for your campaigns. Additionally, you bring on skilled salespeople who are adept at converting leads into clients. The effectiveness of your sales team directly impacts your ability to close deals and increase revenue. When you invest in hiring skilled individuals who excel at selling, their expertise becomes a valuable asset for your business. Their knowledge and abilities can significantly increase your revenue, making it a smart investment. You can easily measure the return on this investment by tracking monthly expenses and commissions for each salesperson and comparing it to the revenue they generate. This allows you to see the direct impact of their skills on your bottom line. For those who don't have a company or aren't in a position to hire others, there's another approach. You can become the asset yourself. By acquiring valuable skills that are in demand among entrepreneurs, you can enhance your own earning potential. The more proficient you become in these skills, the higher the value you can offer, leading to greater financial rewards for your expertise. Essentially, investing in your own skill development can provide a similar return on investment as hiring talented professionals. If you enjoyed this video, give it a thumbs up and share your thoughts in the comments. For more informative content on finance, entrepreneurship, and self-improvement, subscribe to our Voice of Wealth channel. We post new videos every other day to help you succeed in various aspects of life. Have a great day and see you in the next one.